Welcome to House Lux Estate, your guide to understanding complex financial concepts in simple terms. Today, we're unraveling the concept of liquidity, a term that might sound fluid and flowing, and rightly so. Liquidity refers to how quickly and easily an asset can be converted into cash without affecting its market price. This could range from cold hard cash itself, which is perfectly liquid, to assets like real estate, which are considerably less so. Understanding liquidity is crucial not just for your personal financial health, but also for the broader economy. For individuals, liquidity means having access to cash when you need it, whether for an emergency, a major purchase, or to seize an investment opportunity. For economies, liquidity is like the oil that keeps the engine running smoothly, ensuring that businesses can operate, grow, and contribute to economic stability. Now let's dive deeper into what liquidity actually means. When we talk about liquidity, we're referring to how easily assets can be converted into cash. This concept is a cornerstone in both personal finance and business operations, serving as a barometer for financial health and flexibility. Let's dive deeper into what constitutes a liquid asset. The most straightforward example is cash itself. Cash is the epitome of liquidity because it doesn't need to be converted or processed. It's ready to use immediately. Close on its heels are assets like stocks or bonds. These can typically be sold on the market relatively quickly, often within days or even hours, making them highly liquid. However, not all assets enjoy this level of fluidity. Consider real estate or fine art. These are considered less liquid assets because converting them into cash is not a quick affair. It involves a lot of processes, from finding a buyer to negotiating prices and completing legal formalities, which can take months or even years. The liquidity of an asset is not just a matter of convenience, it has profound implications. For businesses, high liquidity means having the ability to cover short-term obligations without stumbling financially. It allows companies to seize opportunities swiftly or manage unexpected expenses. For individuals, liquidity is equally critical. It impacts one's ability to handle emergencies or take advantage of timely investment opportunities without incurring significant losses or costs. But here's an interesting twist. While having liquid assets is advantageous, it's not without its trade-offs. Highly liquid assets, like cash, often yield lower returns compared to less liquid investments like real estate or a stake in a private company. This is because the latter can potentially offer higher returns due to their inherent risks and the longer commitment they require. In essence, liquidity isn't just about how quickly an asset can be turned into cash. It's also about balancing the need for ready money with the desire for higher returns. It's a fundamental aspect of financial strategy, affecting decisions in both personal finance and business operations. So, high liquidity means easier access to cash, but there's more to it. Having liquid assets can be a game changer in personal finance. Imagine this. You wake up to a leaking roof or a car that won't start. Such emergencies can spring up without warning, and how you handle them can drastically affect your financial stability. This is where liquidity, or the ease of converting assets into cash, becomes crucial. Liquid assets like a savings account or easily sellable stocks can be the difference between a quick fix and a financial crisis. Now let's consider investment opportunities. Opportunities don't come knocking with a warning. The stock market might present a golden chance to buy shares at a low price, but such opportunities often require quick action. If your assets are mostly tied up in real estate or long-term bonds, you might just miss out. Liquidity ensures you have the cash available to seize such opportunities without the need to liquidate assets at a loss. However, the lack of liquidity carries its own risks. For instance, being cash-strapped in urgent situations can lead to undesirable outcomes. Without accessible cash, you might have to rely on high-interest loans or credit cards, leading to a cycle of debt. Or worse, you might be forced to sell off assets at a much lower value than they're worth, causing a significant financial setback. So, how does one improve liquidity? First, it's wise to maintain a portion of your assets in easily accessible forms. This might mean having a savings account with a sufficient emergency fund that covers at least 3 to 6 months of living expenses. Additionally, consider diversifying your investments to include some with shorter maturity periods or that can be easily liquidated. Investing in liquidity is not about hoarding cash, but strategically managing assets so that you're prepared for both the expected and unexpected financial demands. Clearly, liquidity isn't just a business concern, it's pivotal in our personal lives too. Liquidity doesn't just keep your personal finances afloat, it also oils the wheels of the entire economy. Now imagine a scenario where every financial transaction, from buying a cup of coffee to trading stocks, occurs without a hitch. This seamless operation is largely due to liquidity. In financial markets, liquidity refers to the ability to buy or sell assets quickly without causing a significant price change. This fluidity is crucial for maintaining economic stability and confidence. Financial markets thrive on liquidity. It reduces the cost of trading and investing, leading to more vibrant and active markets. For instance, when a stock is highly liquid, it means you can sell it swiftly at a price close to the market rate. This ease of transaction attracts more participants, from individual investors to large institutions, all of whom contribute to a dynamic marketplace. Central banks play a pivotal role in managing this liquidity. They use various tools, such as adjusting interest rates and buying or selling government bonds, to ensure there is just the right amount of money flowing through the economy. These actions influence everything from inflation rates to employment levels. For example, by lowering interest rates, a central bank can encourage borrowing and spending, thus injecting more liquidity into the system. However, the absence of sufficient liquidity can lead to crises. Historical examples abound, such as the global financial crisis of 2008. During this period, liquidity dried up as trust between financial institutions faltered, leading to a cascade of failures and bailouts. Banks hesitated to lend not only to each other, but also to businesses and consumers, causing a significant economic slowdown. Understanding these dynamics shows us that liquidity is not just a technical aspect of financial markets, but a cornerstone of economic health. Whether it's ensuring that businesses can secure loans to expand, or that governments can fund essential services, liquidity supports a wide array of economic activities. From banks to businesses, liquidity is the silent powerhouse of economic operations. While liquidity is essential, it's all about balance. Imagine you are a juggler. Each ball represents a financial asset. Some balls are made of rubber, easy to catch and throw. These are your liquid assets like cash or savings accounts. Others are made of glass, heavier and riskier to handle. These symbolize long-term, less liquid investments like real estate or stocks. The art of financial management, much like juggling, involves keeping these balls in motion without dropping any. This balance is crucial for your financial stability and growth. Holding too many rubber balls might seem safe. They're easier to manage and less likely to cause a loss when dropped. However, this safety comes with a cost. Liquid assets often yield lower returns compared to more solid long-term investments. If you're overly cautious, keeping most of your wealth in liquid forms, you might miss out on higher returns from investments like stocks or real estate, which have the potential to appreciate over time. On the flip side, if your hands are full of glass balls, you risk them crashing down. Overinvesting in assets that are difficult to liquidate quickly can lead to problems if you suddenly need cash. Imagine needing to sell a property when the market is down. This could lead to significant financial losses. So how does one achieve a good liquidity balance? Start by assessing your financial goals and risk tolerance. Establish an emergency fund that covers 3 to 6 months of living expenses. This is your safety net of rubber balls. Beyond this, consider your long-term financial goals. Are you saving for retirement, a child's education, or perhaps a significant purchase? Depending on your timeline and risk appetite, allocate portions of your wealth into more solid investments. Diversification is your friend here. It spreads risk and can provide a smoother financial ride. Think of it as not just juggling balls of different materials, but also different sizes and weights, each contributing uniquely to your financial performance. Striking the right liquidity balance can significantly enhance financial health and opportunities. Today, we've navigated through the fluid world of liquidity. To encapsulate, liquidity refers to how quickly and easily an asset can be converted into cash without affecting its market price. This concept isn't just a cornerstone of financial markets. It's a fundamental aspect of managing personal finances. Whether it's for an individual or a corporation, liquidity is crucial for operational stability and flexibility. We explored how liquidity plays a pivotal role in personal finance, helping individuals prepare for emergencies and seize opportunities without the need to incur high costs. On a larger scale, liquidity in the economy allows businesses to thrive, supporting employment and economic growth by ensuring that companies can meet their short-term obligations. Balancing liquidity is an art. Too much liquidity can lead to missed opportunities in investment growth, whereas too little can create financial stress or even lead to bankruptcy in dire situations. Understanding and managing liquidity effectively can lead to smarter financial decisions and a more secure economic future. Thank you for tuning in to House Lux Estate. Don't forget to subscribe for more insights into the financial world. Stay financially savvy and see you in the next video.